In this video, I'm going to show you the one thing that all real estate crashes have in common.
The U.S. federal debt is on an unsustainable path.
Now, we all know that the collapse of the real estate market is going to be caused by debt. But this video is all about the switch that causes the first domino to fall. And we're going to get into the trigger towards the end of the video, so stay to the end. When that trigger happens, the economic reality of the economy detaches and prices crash overnight.
And no one really knows how much further we can go. Other countries over time have gone much farther, but we're now, we're running very large deficits at full employment. And this is a situation that we very much need to address. Sooner or later we'll have to, and sooner is better than later.
Now we are going to expose the exact trigger that's going to cause this in the video. Give us the like thumbs up if you're good with that. It helps the algorithm and gets this message out to people who need to see it most. So yet another reason to give us that like thumbs up. We are seeing signals in the market right now, but the media can't report this to you because they don't have the data. Everyone is screaming, the sky is falling right now, especially a lot of people on YouTube are doing it, but it is false because they are missing the single most important factor in this equation, and that is that prices make sense. They're just tracking with economic fundamentals. Inflation has hit big time over the last 5-6 years. And the high prices are just a result of this inflation that has occurred. So people in the know, people that realize that this has happened, don't mind paying these higher prices because they know inflation is going to continue. Maybe not at the rate that it has in the past, but it is going to continue. The dollar is going to decline in value and everything's going to seem like it's getting more expensive. But I'm going to explain why everything's not getting more expensive later in this video. And if you don't agree with me, I'm open to conversation. Put your comment down below. I'd be happy to converse with you. So I encourage it. So back and forth dialogue is what I'm hoping for in this video. And I encourage you to make a comment down below. What we've got on the screen right now is a Federal Reserve chart. Link down below in the description. Now this chart, it shows us the money supply and the number of transactions that are going on in the country year over year. So the blue line is the money supply. The red line, number of transactions. You can see what's going on. The money supply, this little gray area, is actually a recession caused by the pandemic. So the money supply went way up during that time. And then nothing happened with prices for sometimes there's a little stall. And then the number of transactions of homes went way up, but not enough homes for sale. So prices, as a consequence, also went way up. Now you can see that the money supply came down 2023, and then the number of transactions also came down. And you can see this line is now crossing right here, second quarter of 2025. That is because of the lock-in effect. Now, if you're not familiar with the lock-in effect, you want to click this video right here. It explains all about it. It's another video that I have online. Link to this chart and many others, as you can see down here on the Federal Reserve website, are available down below in the description. Now, as you can tell from the chart, home prices match the inflation rate, and basically the more money that's injected into the economy, the higher prices are going to go. In the long run, the prices are going to go parabolic. So no one knows when the dollar is going to crash, and it's not going to be the reserve currency of the world any longer. But eventually it is going to happen. It's happened countless times before in history, and it's going to happen again. So we want to be prepared for that by owning hard assets. Assets like real estate.
The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth.
Now, inflation exists everywhere in the country, but it's far more prevalent here in California. With more people comes more demand, but this is not just about demand. It's something far more sinister going on, and that's corruption. Baked into every layer of our state and local governments, every permit fee, every ounce of bureaucratic red tape gets passed directly into the price of every square foot of real estate sold in California. This isn't a bubble. It's the cost of doing business in a broken system, and we all pay the price. Speaking of things in freefall, don't let this economy catch you without a parachute. While the dollar is plummeting, we're here to help you land safely. Hit that subscribe button below so you don't miss the next signal. It's going to be on this channel, so subscribing is the best way for you to stay in the know. Now we have to look at the bigger picture. Nationally, we've seen the price of many valuable assets like precious metals go up exponentially, signaling a currency crisis rather than a housing bubble. Look at the cost of precious metals. Gold is over $4,000 an ounce right now. Let's take a look at a gold chart where we price homes in terms of gold. Okay, here it is, real estate to gold ratio. You can see back in 1971, we were at all-time high. That's when Nixon took the United States off the gold standard. Now this is real estate priced in gold. And if you have, the link to this is down below in the description if you doubt anything that I'm saying right now. But from 1971, the price of housing actually plummeted. And all the way over to where we are today, you can get a house for less than you could pretty much any time in history as long as it's priced in gold. So here's the current data. It's using the U.S. home price of $588,000 and gold price $4,076 an ounce. One of the huge benefits that real estate has over gold is real estate, you can produce a cash flow when you rent it out. Plus, gold doesn't depreciate, but real estate does. So that's a huge benefit on your taxes every year. You could depreciate real estate. So in my personal humble opinion, I think real estate is a far better investment than gold. Now, if a house costs more dollars, but it takes fewer ounces of gold to buy that very same house than it did in 1990 when the price of gold was like $385 an ounce, has that house gotten more expensive? I think not. The dollar has just gotten less and less valuable over the years. So it takes more of them to buy that very same house. Now the dollar, like all fiat currencies in the history of the world, will become worthless eventually. It's just a matter of when. And according to Jerome Powell, it's the not too distant future. Now, if the dollar becomes worthless, what happens to the price of homes? That's right, they go up parabolically, just like the price of gold in the chart. Now, here's the price of gold to date. Over $4,000, almost $4,060 an ounce. Here's 1 year, 5 years, quite the increase, all time. It's going up parabolically, it looks like right now. It's a massive increase. Now, several years ago, I had a client that actually wanted to purchase a home in Bitcoin. But escrow said, no, we have to have dollars. Sorry. You're going to have to convert your Bitcoin to dollars, deposit those dollars into escrow, then we can complete the transaction. But in the future, maybe Bitcoin will be the currency that people use to buy homes. Maybe it will be priced in gold or silver. Who knows? But right now, we don't have a crisis. Everything is still priced in dollars. So if high real estate prices aren't the cause of the real estate crash that's possibly coming, then what is? At the beginning of the video, I promised you that I would address this. Now, in 2008, we had the great financial crisis. Before that, we had the dot-com crisis. We had a little bit of a crash. In 1990, we had the savings and loan crisis. The biggest crash has not happened yet. The next crash will be a liquidity shock. It's when the banks just stop lending and will not start lending until another form of value is found, like Bitcoin or gold, whatever it is. If it's not dollars, it's got to be something else, and no one will lend. When banks will not lend, the markets will crash until an alternative is found to financing these homes. When we had our previous liquidity shock in 2008, the trigger wasn't that homes were too expensive. It was that banks realized that the collateral or the homes weren't worth what they were lending on. That's why an appraisal is required for every home that's purchased with financing. If your collateral is bad, no one's going to lend. Now, despite higher interest rates, money is still flowing because the government is printing money to service its own debt. Now, this will continue to drive asset inflation. The cost of an ounce of gold will continue to go up. As long as an ounce of gold is over $4,000 an ounce and rising, the market is telling you that hard assets are a safe haven. Real estate is a hard asset, but real estate also has huge advantages over gold. Real estate produces a cash flow. You could actually make money every month just for owning real estate. Not the case with gold. Also, you could depreciate real estate. It has huge tax advantages over gold. So if you're on the fence, don't wait for a crash to buy a house. That's the biggest mistake you can make. I've had countless clients tell me,
"Oh, I don't want to buy at the top."
well, guess what? It's been at the top for every year since 2014. And every day that your money sits in the bank, it's losing buying power. Every single day, it's becoming a little bit more worth less. So stop looking at the price tag and start looking at the value in terms of gold, for example, of the house that you're thinking about buying. Now, for all the homeowners out there who own a house that are thinking about selling, I want you to watch this video right here. This one is on why selling your house could be the worst financial mistake you'll ever make. This is a hugely valuable video. You've got to watch it. Just click right here.